Hey everyone, welcome back for another deep dive.
Always a pleasure to be here.
Today we're tackling something that's kind of well, the undercurrent of everything in investing, right?
Absolute.
Risk. We've got this awesome piece called Pasted Text, and it lays out 20, count them, 20 key investment risks.
Yeah, there are a lot.
We won't get to all of them today, but we're going to do a real deep dive into a bunch of them.
That should be fun.
So before we jump into the specifics, can you give us kind of the big picture? Like, what's the core concept here that we absolutely need to wrap our heads around when it comes to investment risk?
Well, first and foremost, it's got to be that every single investment out there has some level of risk. You just can't escape it, right?
Right.
There's no such thing as a risk-free investment, no matter what anyone tells you.
Definitely good to keep in mind.
Understanding that basic idea is, I think, the starting point for building any smart investment strategy.
So true. So then how do we even start to, I don't know, unpack all these different types of risks?
It can get pretty overwhelming, right?
Totally.
Well, a good place to start is figuring out your own personal risk tolerance.
Hmm.
So that's basically how much risk you as an individual investor are actually comfortable taking on.
Yeah.
And it should really be tied to your goals, right?
Sure.
Financial goals, how long you've got to invest, your time horizon.
Makes sense.
Even honestly, your personality plays a role. Someone who's saving for retirement, way down the line, they might be cool with more risk than someone saving for, say, a down payment on a house next year, right?
Yeah. Big difference there. The whole time horizon thing, it's huge.
Absolutely.
So speaking of market ups and downs in time,
Yeah.
one of the first risks our source material dives into is market risk. So break it down for us. What exactly is market risk, and why does it seem like it's always on everyone's minds?
Well, market risk is, the risk that the entire market as a whole, so we're talking stocks, bonds, real estate even, declines in value. Basically, everything's headed down.
Makes sense.
And there are a bunch of things that can drive this,
Yeah.
economic downturns, some crazy global event nobody saw coming, interest rate changes.
Sure.
Or even just how investors are feeling, the overall sentiment. A classic example is the 2008 financial crisis.
Oh, yeah?
That was market risk in action. It whacked even investments that everybody thought were super safe.
2008 was rough.
It was.
And it brings up a question even if you're diversified, your investments can still lose value during a big downturn, then how can anyone really feel like, okay, I'm good in the long run?
Diversification's still a must, though.
Okay.
Even though your diversified portfolio might take a hit, the idea is to soften the blow, right?
Yeah.
Not necessarily get rid of losses entirely. If you're really concerned, a financial advisor can always help you figure out the best mix of assets for you, based on your goals and how much risk you can stomach.
Makes sense. So there are two other risks in our source material, and they're kind of lumped together a lot. Credit risk and liquidity risk.
Yeah.
Why are those always mentioned? Side by side?
Well, they're super relevant when you're looking at investments like bonds and loans, Let's start with credit risk, which is basically the risk that a borrower is just not going to pay back their debt,
It's never good.
So think about a company that issues a bond, right?
Yeah.
Then down the line, they hit some financial trouble,
Mm.
Now, their ability to keep making those interest payments or pay back the principal when the bond matures, it could be in jeopardy.
Right.
Which obviously means potential losses for the people holding those bonds.
That's super clear, thanks. But then what about liquidity risk? How does that fit in with the whole bond example?
Okay, so picture this. You've got these bonds, right, from this company that's now in trouble.
Okay.
Investors are getting nervous, worried about whether they'll ever get their money back.
Yeah.
Now suddenly, those bonds are way harder to sell.
Oh, I see.
You could be stuck with this investment, and there's no easy way to turn it back into cash without losing a bunch of money.
Ouch.
That's liquidity risk in a nutshell. The risk that you can't quickly convert your investment into cash, at a price that's fair.
So basically, credit risk and liquidity risk can kind of make each other worse.
Exactly. They're definitely intertwined, especially when you're dealing with fixed income investments like bonds.
Gotcha. Okay, let's shift gears for a second and talk about systemic risk, that whole domino effect thing.
Yeah, that's a big one.
It kind of sounds like the plot of a financial thriller.
A little bit, yeah.
Can you break down what it is and why it should be on everyone's radar?
So systemic risk is basically the risk of a total meltdown of the entire financial system.
Oh, wow.
Where one institution goes down and it triggers a chain reaction that takes down a bunch of others. It's like dominoes, one tips over, and then the whole thing's at risk of collapsing.
Yeah.
And our global financial system is so interconnected that this risk gets amplified. It's super complex to manage.
Would you say that, like, the 2008 crisis is a real-world example of systemic risk?
100%. When Lehman Brothers, this huge investment bank, collapsed, it sent shockwaves through the entire system,
Yeah.
showed everybody just how interconnected and, frankly, fragile things really are.
Scary stuff. Okay, let's switch to a different kind of risk that's become a much bigger deal recently. ESG risk.
Yes. ESG is super important.
It's about more than just companies being good, right?
Really.
It can actually impact their bottom line and their investors' returns.
You got it. ESG stands for environmental, social, and governance factors. And they're not just some nice to have for investors anymore. They're real material risks that can seriously affect a company's long-term sustainability and value. So think about a company with really bad environmental practices, right? They might get hit with huge fines, or people might boycott their products.
I've seen that happen, yeah.
Exactly. That hurts their profits, their stock price takes a hit, and investors lose out.
So how can investors even figure out how to manage ESG risk? It seems really complicated.
It's a lot to keep track of, no doubt.
Yeah.
But there's more and more info out there to help you. There are specialized ESG rating agencies that look at how companies are doing on this stuff.
Oh, interesting.
And a lot of asset managers are starting to include ESG factors in their investment process.
That's good news. So it sounds like there's a lot of movement in this space, and investors are becoming more aware of ESG stuff.
Absolutely. ESG investing is evolving so quickly. It's something everyone needs to be paying attention to.
Okay, before we wrap up, I want to touch on a couple of risks that are kind of less about, the outside world and more about, like, what's going on in our own heads as investors.
Yeah, the mental game.
Right. Our source talks about behavioral bias and timing risk.
Oh, those are classic.
What are those all about?
So behavioral biases are basically like mental shortcuts our brains take, and they can often lead us to make not so smart decisions, especially with money. Like, there's this thing called loss aversion, right?
Okay.
Basically, we feel the pain of losing money way more strongly than the happiness of gaining the same amount.
That's so true.
It can make people hold on to investments that are tanking, hoping they'll come back.
Yeah, I think we've all been there.
Or they'll sell investments that are doing great way too early because they're scared of losing their gains.
Guilty. What about timing risk? It's like trying to,
Catch a falling knife.
Yeah, exactly.
Timing risk is all about making the wrong choices at the worst possible time. Trying to perfectly time the market, buying at the absolute bottom and selling at the peak. It's practically impossible.
Seems like it is, yeah.
And our emotions like fear and greed, they mess with our judgment so much,
For sure.
We end up buying high and selling low, which is like the opposite of what we're supposed to do.
It really is. So after this whole deep dive into investment risk, what's the one thing you want listeners to take away?
It's this. Risk is just part of the game when it comes to investing. But don't be scared of it.
Right.
Understand it. Learn how to manage it,
Yeah.
By recognizing the risks, doing your homework, and making informed choices, you can definitely improve your chances of reaching your financial goals.
Awesome. Couldn't have said it better myself. And remember, everyone, this deep dive's really just the beginning,
Totally.
There's a ton of info out there to help you become a smarter, more confident investor.
Keep learning.
Keep learning, keep exploring, and make those smart choices.
Exactly.
We'll catch you next time.
See ya.